Valuation logic of gold. Next, I'll explore how the market values gold under different economic conditions. Gold prices fluctuate as the economic environment and monetary policies change. By observing these fluctuations, we can see that gold often correlates with economic indicators such as GDP and interest rates. Based on these correlations, I have summarized a GDP equivalent model for gold prices and a correlation model that connects gold with interest rates and other economic indicators. In the early 1980s, as oil prices surged, G7 countries raised interest rates to combat rising inflation. This led to gold's first major price peak after the breakdown of the Bretton Woods system in 1971. If we use U.S. GDP and gold prices post-Bretton Woods as a reference, we can derive the U.S. GDP equivalent price of gold. During this period of high inflation, the gold price exceeded the GDP equivalent price curve significantly, showing that despite the Federal Reserve's high interest rates, people were eager to buy gold to protect against inflation. In the 1970s and 1980s, gold prices generally fluctuated around the U.S. GDP equivalent price. The Fed's high interest rate policy in the early 1980s caused the yield on U.S. 10-year Treasuries to exceed 15%. Once inflation was under control, long-term bonds, which provided stable cash flows, became more appealing to the market than gold, which led to gold's lost 2 decades. By the late 1990s, under President Clinton's second term, the U.S. achieved fiscal discipline and recorded substantial budget surpluses, strengthening the dollar and pushing gold prices lower. Gold prices fell far below the U.S. GDP equivalent price during this time, as low unemployment and a strong economy made gold less attractive. However, following the bursting of the dot-com bubble in 2000 and the September 11th attacks, the pricing logic for gold shifted significantly. During President George W. Bush's administration, the U.S. fiscal budget rapidly shifted from surplus to deficit, and the Federal Reserve significantly lowered interest rates to stimulate the economy. From 2001 to the 2008 financial crisis, gold prices surged. After the financial crisis, the Fed took unprecedented steps, slashing interest rates to near zero, and gold prices continued to rise, hitting their second peak at the U.S. GDP equivalent price. Unlike the first peak, which was a response to actual inflation, this second peak reflected market expectations of future inflation driven by the Fed's quantitative easing policies. Since there wasn't significant actual inflation during this period, gold's second peak didn't far exceed the GDP equivalent price as it had during the first peak, but rather returned to it. Another important event before this gold price surge was China's accession to the World Trade Organization, WTO, on December 11th, 2001. This event rapidly integrated China's economy with the global market, boosting GDP growth worldwide and leading to a massive increase in China's foreign exchange reserves. The key economic features of this period were rising U.S. fiscal deficits, the Fed's accommodative monetary policy post-crisis, and China's large-scale gold purchases as foreign reserves. These factors made gold prices particularly strong. Gold prices began to retreat after reaching their second peak in 2013. I will later introduce the interest rate correlation model to explain the market logic during this period. From the second peak in 2011 to September 2024, gold prices have generally remained below the U.S. GDP equivalent price. As of September 2024, gold prices have surpassed $2,600 and are approaching the U.S. GDP equivalent price of $2,900. If we reference the second peak from 2011, this price range could mark the third stage peak for gold prices. Before and after the pandemic, central banks in China, India, Japan, and other countries significantly increased their gold reserves, providing strong support for gold prices. Could the global GDP equivalent model for gold reflect the demand from these central banks? As shown in the graph, global GDP equivalent gold prices continuously exceed the U.S. GDP equivalent prices after 2004. Based on the World Bank's 2023 global GDP figures, the global GDP equivalent model values gold at around $3,100. Given the ongoing de-dollarization trends in developing countries, global GDP equivalent prices could become a long-term benchmark for gold. Historically, gold has only reached global GDP equivalent prices once before, in the early 1980s. We see that the first and second peaks in gold prices were both related to high inflation. Gold's price increases were proportional to inflation intensity, and excessive money printing was one of the main causes of high inflation. Next, I will introduce the U.S. Monetary Supply (M2) equivalent model, using M2 as an indicator to explore the relationship between the U.S. money supply and gold prices. Using the same method as the U.S. GDP model, this M2 MICE equivalent model shows that gold prices during the second peak fluctuated between the U.S. GDP and M2 equivalent prices. After the pandemic in 2020, the Fed's aggressive quantitative easing led to a rapid increase in M2. As of September 2024, the M2 equivalent price stands at around $3,700, significantly higher than both the US and global GDP equivalent prices. If inflation remains under control, this level could mark the long-term peak for gold prices. The chart summarizes these three models, showing potential future gold price ranges: U.S. GDP equivalent prices for short-term peaks, global GDP equivalent prices for long-term averages, and U.S. M2 equivalent prices as the long-term peak if inflation remains moderate. Now, I'll introduce another important valuation model, the gold and interest rate correlation model. After gold reached its second peak in 2011, the S&P 500 gradually surpassed its pre-2008 financial crisis high, reflecting the recovery of the U.S. economy after nearly 5 years of near-zero interest rates. Gold prices began to fall, but did not collapse, instead stabilizing within a valuation range. This period lasted from 2013 to 2022, 10 years in total. During this time, the Fed first raised interest rates in 2016, then lowered them back to near zero after the 2020 pandemic. Gold prices showed a strong correlation with interest rates and other economic indicators during this period. Using regression analysis, I developed a gold interest rate correlation model, which, unlike the GDP equivalent model that tracks overall trends, can follow real-time gold prices based on interest rates and economic indicators. Between 2013 and 2022, the gold interest rate correlation model closely matched actual gold prices. This means that if given the necessary interest rate and economic data, this model can provide near-market gold prices. Conversely, if gold prices significantly deviate from this model, it signals a major shift in market logic, offering an indicator of changing market dynamics. I've created a Google Sheet with more detailed explanations of the GDP, M2, equivalent models, and the interest rate correlation model, along with a comparison of these models against actual gold price trends. You can input GDP and other economic indicators to obtain reference prices for different gold valuation models. Interested readers can check out the details via the Patreon link below. From 2023 onward, gold pricing logic has fundamentally shifted. Gold prices have significantly deviated from the interest rate correlation model, mirroring the price pattern seen after 2008. Initially, gold and the correlation model aligned closely, but then gold prices moved towards the U.S. GDP equivalent price. This reflects a loss of market confidence in the U.S. dollar and a renewed reliance on gold's inflation hedging properties. After the pandemic, U.S. debt levels reached record highs, surpassing 120% of GDP. Central banks in Asia, including China, India, and Japan, significantly increased their gold reserves, echoing the situation before the breakdown of the Bretton Woods system in 1971. Back then, the U.S. adopted a loose monetary policy to fund the Vietnam War and social welfare programs, which led European countries to abandon the fixed exchange rate system with the dollar, converting their dollar reserves into gold and forcing the U.S. to end the dollar-gold peg. Similarly, post-pandemic, the U.S. adopted an ultra-loose monetary policy, significantly increasing debt and liquidity. The resulting high inflation forced the Fed to raise interest rates rapidly, leading to a sharp decline in U.S. bond prices. Foreign central banks holding large amounts of U.S. debt faced substantial paper losses. The shortage of overseas dollars, combined with these losses, has severely undermined confidence in the dollar system, prompting Asian countries with large dollar reserves to increase their gold reserves, just as Europe did in the 1960s. This central bank and public buying behavior has effectively supported gold prices. Today's U.S. economy combines characteristics of the early 1980s, high inflation and high interest rates, with the quantitative easing environment of the post-2008 financial crisis. These factors provide strong support for gold prices. As of September 2024, gold has surpassed $2,600, approaching the U.S. GDP equivalent price. However, if U.S. inflation is effectively controlled and long-term bond yields exceed the inflation rate, gold prices could peak and return to the interest rate correlation model's price range. Another possibility is that as BRICS nations continue to buy gold, its price could fluctuate around the global GDP equivalent level in the long run. While we can't predict whether current monetary policies will successfully curb inflation, it's clear that, given the scale of U.S. fiscal deficits, it is unlikely the U.S. will return to the budget surplus of pre-2001. This means long-term bond yields will likely not exceed inflation by much, making a repeat of gold's lost decades. Postscript 2001, a watershed year in world history that changed the fate of two nations. This concludes my analysis of the historical trends in gold prices. Now I'd like to share some broader reflections. Over the past 30 years, 2001 stands out as a historically significant year. Not because of 2001, A Space Odyssey by Sir Arthur Clarke, but because the global economy and the logic behind gold pricing underwent major shifts starting that year. Two monumental events in world history occurred: the September 11th terrorist attacks in the United States, and 3 months later, on December 11th, China officially joined the World Trade Organization, WTO. The War on Terror entangled the U.S. in Afghanistan for 20 years, once again reinforcing Afghanistan's reputation as the graveyard of empires. It also transformed America's financial position from a surplus to unsustainable deficits. From that point on, the U.S. government had to rely on debt issuance and money printing to sustain its economy. Fortunately for the U.S., it coincided with the economic rise of China, India, and Southeast Asia. These developing nations exchanged cheap goods for U.S. dollars, preventing the kind of rampant inflation that followed the Vietnam War. These countries not only developed their economies during this period, but also indirectly financed America's war in Afghanistan. China's entry into the WTO made it an indispensable part of the global supply chain, and its vast market began reshaping the world economy. For gold, 2001 was also a pivotal moment. In the years before 2001, the U.S. had a relatively stable fiscal situation, leading to a weaker gold market. Gold was undervalued compared to its GDP equivalent price and interest rate correlated price. But after 2001, as China's and the world's GDP surged and the U.S. adopted loose monetary policies to fund the war on terror, gold prices strengthened. Finally, it's important to note that the equivalent gold price models are based on the assumption that the global economy reacts efficiently to market conditions. Economic growth and the expansion of capital eventually reflect in prices. In The Wealth of Nations, 1776, Adam Smith spoke of the invisible hand guiding behavior in a free market economy. The cumulative effect of individual actions unconsciously shapes the direction of the economy. The participants in the gold market are diverse, ranging from individual jewelry buyers to central banks. Gold is not only a form or currency, but also a reflection of the global economy. Market participants trade based on their own understanding of economic conditions, which ultimately forms the various price trends as we see in gold. Thank you for watching. I wish you success in your investments.